Well, the Reserve Bank has bitten the bullet, cutting interest rates to a historic low of 2%. The statement that went alongside dropped any reference to more cuts, spooking share market investors, fearing this could be the bottom. For the central bank, concerns over an underperforming economy trumped worries over a Sydney housing bubble, much to the dismay of savers and self-funded retirees. Here's finance correspondent Philip Lasker.
All you can eat for $23 as lunch with friends. It's becoming a luxury many retirees can't afford, and Jim Donovan wasn't celebrating today's rate cut.
A pensioner that's got a couple of bob in the bank, and the best you can get around these days is no more than 3%. So you get 3% on 1,000 or 5,000 or 10 or 20, it's not much.
It'll be even less now that the cash rate has been cut to a new record low of 2%, leaving the standard variable home mortgage around 5.4%, saving $52 a month on an average home loan of $350,000. The Commonwealth Bank chose to raise deposit rates slightly and passed on a 20 basis point rate cut to home borrowers.
It's all right for the people who've got these high mortgages. And
it was all right for builders as well, who welcomed the cuts despite concerns about an overheated property sector.
It will improve confidence and ensure that the housing sector continues to perform.
There was no talk of emergencies as Treasurer Joe Hockey did his best to supercharge the interest rate cut.
I say to the Australian people directly, now is the time to borrow and invest. Whether you be a household or a small business, now is the time to have a go.
But credit ratings agency Fitch didn't want everyone to have a go, as it issued a warning about borrowing for property.
Given some of the growing risks we've seen in the mortgage books for the banks, that the regulators will look to tighten the controls that they've got in place at the moment.
The Reserve Bank balanced its concerns by highlighting some improvement in household spending and stronger jobs growth, but it didn't wash with some.
Against the backdrop of low inflation and unemployment above 6%, they really have no choice but to do what they can and cut rates.
The rationale for cutting rates boiled down to worries about business investment, a benign inflation outlook and the unhelpfully high Australian dollar.
If we look at where the currency is today compared to when they last cut in February, it's about 2% higher, yet key commodity prices such as iron ore are a good 10% lower. So there's a mismatch going on here.
The Australian dollar went up today because the RBA did not signal that further rate cuts were likely.
The RBA is generally a reluctant cutter. We are down at historically low levels. The case to cut further has to be fairly compelling.
But many aren't convinced that interest rates have bottomed.
If the economy remains weak, there's no reason in my mind why they won't cut further.
It'll just take a little more time to get to that point.
There are now just